Welcome to the Deep Dive, the show where we take a stack of sources and extract the most important nuggets of knowledge or insight, giving you a comprehensive shortcut to being genuinely well-informed.
Today, we are undertaking a pretty monumental task. We're charting the corporate history, the operational scale, and the radical restructuring of one of the foundational giants of North American logistics, CSX Corporation.
And this isn't just a story about trains running up and down the East Coast, not at all. It's a spectacular story of historic mergers, a deeply ingrained corporate identity crisis that was solved by, of all things, temporary legal paperwork.
Right. And perhaps the most dramatic, activist-driven corporate overhaul the rail industry has seen in, the last decade?
Easily. Our sources give us a really comprehensive look at CSX. We're combining its vast operational scale, we're talking 21,000 route miles, with its high-stakes financial profile.
Yeah, I mean, this is a company that's a component of the S&P 500, the Nasdaq 100, and critically, the Dow Jones Transportation Average, the DJTA. It's a bellwether.
So our mission today is to trace this journey. We want to uncover how this transportation behemoth was, cobbled together, and more importantly, how a modern financial strategy.
Precision-scheduled railroading.
Exactly. How that strategy fundamentally ripped apart and rebuilt its physical operations, its assets, and its workforce in a, frankly, shockingly short period of time.
And the scale of the operation just
Sure.
matters so immensely to the U.S. economy. As a Fortune 500 company trading on Nasdaq, its 2024 revenue topped, $14.5 billion?
$14.5 billion. And it holds total assets of $42.8 billion. It is an absolutely critical piece of infrastructure, serving 23 states, D.C., and reaching into Canada.
Ontario and Quebec. So it really moves the literal economic backbone of the entire eastern United States. It's the infrastructure that makes sure everything from shipping containers to coal, chemicals, auto parts.
All of it. It all moves efficiently. And understanding its complex corporate genealogy, that's really the key to understanding modern supply chain power.
Okay, so let's unpack this. We have to start at the beginning, or maybe the most fascinating part. How this multi-billion-dollar entity ended up with a name that was, for all intents and purposes, an accident.
Right. The genesis of CSX Corporation, the whole reason it exists, it stems from what was billed as this massive corporate wedding, specifically on November 1st, 1980.
That's the day CSX was officially formed as the successor to the merger of two huge historic predecessors, Chessie System and Seaboard Coastline Industries.
And this was intended to be a textbook merger of equals.
Which is a very tricky thing to pull off. When you integrate two enormous, proud, historically significant rail systems, you have to make sure the management, the identity, everything reflects that equality.
And that very necessity for balance is what caused the first big corporate crisis. What do we call this thing?
Exactly. You couldn't just call it Chessie or Seaboard, right? Because that would signal one side won the merger, and it would just kill the whole spirit of the deal.
So the new leadership did the sensible thing. They sent out a probably frantic call for suggestions, asking employees from both railroads for ideas using combinations of C and S.
And they were hoping for something meaningful, something that would truly represent this new combined corporate culture. But, corporate culture moves slowly.
And legal deadlines move fast.
Very fast. While the branding teams were struggling, the company's lawyers needed something immediately. A temporary legal identifier for the formal proceedings with the Interstate Commerce Commission, the ICC.
The regulatory body overseeing the whole merger.
Right. And here is the true aha moment of accidental corporate identity. They needed a quick three-letter name, so they tried CSC. The ICC told them, nope, that name is already legally registered by a trucking company in Virginia.
Okay, so then what?
Then they tried CSM, which is supposed to stand for Chessie Seaboard Merger. But that, too, was already taken.
So they're running out of options.
They're running out of three-letter initialisms combining C and S. So in a moment of, I can only imagine, legal desperation, the lawyers just settled on CSX as a temporary placeholder.
Just a placeholder, with the full intention of replacing it once the branding team came up with something better.
But the momentum of legal registration just took over.
Whoa.
It was easier to keep the temporary name than to launch a whole new round of legal paperwork for a new one.
And that placeholder stuck. It became the official permanent identity of one of the largest corporations in the American East.
It's just a great lesson in corporate inertia. The internal pressure for a quick legal fix completely overrode the corporate desire for a meaningful brand identity.
So once the name was permanent, they had to, retroactively justify it. They had to spin it.
And that's where we get the famous PR spin. This is the most common kind of romantic interpretation. C for Chessie, S for Seaboard, and X is the multiplication symbol.
The idea being, together we are so much more.
Right. But the reality is that the name reflected an initial failure to merge cultures, which necessitated a lawyerly fix, which then necessitated a PR spin.
There's another interpretation, though, right? A less romantic one?
Yeah, a 2016 Railway Age article cited an alternate theory that the X actually stood for consolidated.
Which, that makes a certain amount of sense given the industry's history of consolidation, just combining smaller, failing lines into bigger, more stable systems.
It does. But whether you think it's multiplication or consolidation, the bottom line is the name was defined by legal constraint, not corporate vision.
And the legal headaches didn't even end there. We have to talk about this deeply nerdy but really important detail of the railcar reporting mark.
Oh, this is a great example of the highly regulated nature of railroading. So when CSX needed to use that name as the standard letter code to identify who owns the physical railcars,
They had to add a fourth letter. Why?
because industry rules dictated that any reporting marks ending in X signify that the railcar is owned by a leasing company or a private car owner.
Not a rail line that's operating as a common carrier, which is a company obligated to transport goods for any customer.
Precisely. So the placeholder name that stuck CSX was immediately problematic and required them to add a fourth letter just to comply with basic industry standards. It just underscores how hard it is to change course once a legal identity is set.
So moving on from the name to the actual operation, it's important to remember that merging the holding companies didn't mean the rails were immediately integrated.
No, not at all. The various railroads they inherited from Chessie and Seaboard weren't unified until 1986. That's 6 years after the parent company was formed.
6 years. That's how long it took to functionally merge hundreds of separate operating schedules, maintenance protocols, and tracks into the single entity we now know as CSX Transportation.
And the sources highlight the early need for balanced leadership to reinforce that merger of equals idea. Prime F. Osborne III, who came from the Seaboard side, was the founding chairman of CSX Corporation.
And Hayes T. Watkins Jr. from the Chessie side served as the first CEO and later the second chairman.
That split leadership structure, with different veterans from the predecessor companies holding top roles, was absolutely essential to get cultural buy-in and to signal parity across the new company.
Osborne's influence is interesting because he clearly anchored the company to the south. While the corporation was initially based in Richmond, Virginia, it moved its headquarters in 2003 to the CSX Transportation Building in Jacksonville, Florida.
And that move wasn't just arbitrary. It centralized their operations closer to the core of the powerful former Seaboard system, firmly establishing Jacksonville as the operational base for managing that enormous eastern network.
Okay, so let's transition from those corporate origins to the colossal physical reality of CSX today. The core operational entity is CSX Transportation, or CSXT.
And when we classify a railroad as Class I, we mean it's the elite tier, based on massive revenue thresholds set by the Surface Transportation Board. These are the giants.
And their health is intrinsically linked to the national economy. CSXT is one of only 7 Class I railroads in North America.
The scale is just. It's almost unbelievable. We are talking about approximately 21,000 route miles of track.
That's about 34,000 kilometers. This network blankets the East, covering 23 states east of the Mississippi plus D.C. and extending into Ontario and Quebec in Canada.
And that immense geographic reach is impressive on land. But what truly defines CSX's strategic importance is its access to water. The sources say CSX serves over 70 ocean, river, and lake port terminals.
70 ports. Just think about the implications of that number. It means the rail line is this vital logistics connector between inland American manufacturing and farming and the entire global maritime shipping network.
Right. They access major Atlantic and Gulf Coast ports, feed directly into Mississippi River traffic, and handle commerce along the Great Lakes and the St. Lawrence Seaway. This is where the whole concept of intermodal shipping becomes so important.
Exactly. For those who don't know, intermodal shipping is simply moving freight using 2 or more modes of transport, typically a standard container from a ship to a train to a truck.
And CSX's vast network of intermodal terminals lets them efficiently transfer millions of these shipping containers, making them absolutely indispensable to modern global trade. Without that critical rail leg, the system just collapses.
And this empire is still expanding. The sources highlight the significant 2022 acquisition of Pan Am Railways, along with a 50% stake in Pan Am Southern.
That was a highly strategic move. Pan Am Railways operates critical lines in New England, and buying them solidified CSX's competitive reach into the far northeast. It was a way to fill a geographical gap.
And ensure they had full coverage against their competitors in that dense industrial region.
Exactly. Now, moving beyond the main lines, we need to understand the diversified structure of the holding company. CSX Corporation itself is built around three primary industries: rail transport, real estate, and technology.
The trains get the attention, but the land and the data are just as crucial to the profit model.
For sure. Let's zoom in on the smaller but still critical rail subsidiaries. While CSX Transportation is the flagship, they have various joint holdings in smaller lines. We mentioned Pan Am Railways, which is now a direct subsidiary.
But let's look closely at the Winston-Salem Southbound Railway, the WSS. It's a 90-mile short-line railroad. What makes this so strategically fascinating is that CSX jointly holds it with their primary competitor, Norfolk Southern Railway, or NS.
And this just demonstrates the deep historical roots and shared infrastructure of the industry. The line was completed way back in 1910, connecting Winston-Salem and Wadesboro. It was originally jointly owned by predecessors of both CSX and NS.
So why maintain joint ownership in a competitive environment?
It's often about guaranteed feeder traffic. That's the key insight. The WSS connects NS at the north end and CSX at the south end. If they didn't share it, each competitor would have a strong incentive to build parallel, redundant track, which is immensely expensive and inefficient.
So by jointly owning it, they guarantee access to the local industrial customers, the shippers, which feed lucrative freight onto their main high-revenue Class I lines.
And that connection to specific American industries is vital. The WSS Railway moves high-volume, necessary commodities like grain, sand, coal, chemicals, and steel. The sources specifically cite key shippers like Corn Products Company, a major corn syrup manufacturer,
And Owens Brockway Glass Company. And this detail connects the dots for you, the listener. If that single 90-mile short line were to fail, the manufacturing of basic things like corn syrup in Winston-Salem would be immediately jeopardized.
The smallest line is tied to the largest supply chain. We also see P&L Transportation, Inc., a railroad holding company where CSX holds a majority stake. Again, it's a strategic investment in regional logistics to consolidate market power and control local feeder networks.
Now let's talk about the non-rail subsidiaries, the real estate and technology parts that support the main operation. These are the tools that maximize the value of their physical assets.
Right. CSX Real Property and CSX Intermodal Terminals are crucial for asset management, land use, and ensuring containers can move seamlessly.
And the technology side cannot be understated. We see subsidiaries like CSX Technology, Chessie Computer Service, Cybernetics and Services.
Managing 21,000 miles of track in the modern era is fundamentally a big data problem.
Absolutely. Think about the technological complexity. Optimizing locomotive assignments, monitoring track conditions for safety, predictive maintenance, and coordinating schedules across dozens of terminals. Sophisticated tech is what lets them move massive freight volume with a minimal number of people and assets.
And the sources round out the list with logistics arms like Total Distribution Services and TransFlo and international presence through CSX de Mexico and Powerhouse Logistics. It's a genuinely sprawling corporate ecosystem.
Now we have to turn our attention to one of the most complex corporate arrangements in American rail history, the story of Conrail.
Or Consolidated Rail Corporation. This story is central to understanding how CSX operates in the dense, lucrative Northeast corridor.
The history begins with, well, a catastrophe. In the mid-20th century, decades of bad management, economic shifts, and a lack of investment led to the collapse of multiple northeastern rail carriers.
It all culminated in the colossal failure of the Penn Central Transportation Company and the Erie-Lackawanna Railway. By 1976, the federal government had to step in and create Conrail, a massive government-owned experiment just to keep freight moving and prevent economic gridlock.
It was a bailout operation, pure and simple, but things changed dramatically in the 1980s, thanks to pivotal regulatory shifts, specifically the 4R Act and the Staggers Act.
And we need to be clear about what those did. In short, they deregulated the railroad industry. Before this, the ICC had immense control over everything from setting rates to approving line abandonment.
So the 4R Act of 1976 was the first step, but the Staggers Rail Act of 1980 was the real game changer.
It was. It allowed railroads much greater freedom to set rates, enter private contracts, and rationalize their networks. And this deregulation is what allowed Conrail to move from a bloated, money-losing government project into a competitive, efficient, and profitable private enterprise.
It was so successful that it was eventually privatized in 1987.
Conrail was a massive success story, but that success brought its own high-stakes corporate drama. By 1997, the two remaining Eastern-class I behemoths, CSX and Norfolk Southern Railway, decided they wanted it. They agreed to jointly acquire and split Conrail to restore competitive balance in the Northeast.
And the sources note that this action was historic because it essentially reversed the 1968 Penn Central merger, the exact disaster that made Conrail necessary in the first place.
Right. 30 years later, CSX and NS were strategically carving up the resulting entity, effectively correcting the mistakes of the past and ensuring true two-carrier competition in the region.
So after getting regulatory approval, CSX and NS took full control, beginning operations on their respective portions on June 1st, 1999.
So Conrail was split geographically. CSX got one part, NS got another. But here's the profound insight for our deep dive. Conrail did not simply vanish.
It still exists, but its role has fundamentally shifted from being a common carrier to being a crucial management entity. It doesn't operate trains anymore.
It functions strictly as an asset management and network services provider. And let's analyze the complexity of the joint ownership, because this is where the genius of the agreement lies. CSX owns 42% of the Conrail stock, and NS owns 58%.
And that stock ownership split corresponds precisely to the proportion of Conrail's physical track and assets each company acquired.
Exactly. So 58% of the assets went to NS, and 42% went to CSX.
But if NS holds 58% of the stock, wouldn't they control the operation of the residual Conrail?
That's the critical legal maneuver. The sources stress that, crucially, each parent company, CSX and NS, has an equal voting interest 50-50, despite the unequal stock split.
So it prevents either major competitor from dictating the operational strategy of the residual entity. It forces cooperation.
It forces cooperation and ensures that the management of the remaining shared assets is truly equitable. It's a structure designed to enforce healthy competition and collaboration.
That equal voting interest is a truly brilliant piece of corporate risk mitigation. It guarantees they must agree on how to run this key piece of infrastructure.
And what exactly is this residual Conrail managing? Its primary retained asset is the ownership and maintenance of three specific high-density areas known as shared assets areas.
New Jersey, Philadelphia, and Detroit. Why share these areas?
Because these regions are vital industrial and population hubs. If only one carrier served them, that carrier would hold a virtual monopoly on a massive amount of lucrative freight traffic.
Which could lead to inefficiency or potential abuse.
For sure. So by retaining these areas as shared assets, both CSX and NS have the right to serve every shipper within those zones. Conrail's modern function is to act as the neutral third party. It performs the switching operations, terminal services, and track maintenance.
So Conrail handles the local logistics within those hubs, but the contracts are signed directly between the shippers and either CSX or NS, who then pay Conrail fees for the services.
Precisely. Conrail is not a common carrier in this context. It's a share utility facilitator. It's an ingenious managerial structure.
Okay, so if the founding of CSX was defined by its accidental name, the modern era of the company is defined by an absolute, radical, and highly intentional strategy shift.
And it was driven by financial metrics and the cold realities of activist investment.
The change really started when longtime CEO Michael J. Ward, who had been chairman, president, and CEO since 2003, faced mounting pressure.
And the catalyst arrived in 2017 in the form of Mantle Ridge, a high-profile activist hedge fund. They acquired a significant stake, 4.9% of the company's stock, and they didn't hesitate to leverage that to demand radical changes.
Mantle Ridge's demands were clear and aggressive. They wanted Ward to step down, they wanted deep cuts to middle management.
And most importantly, they insisted on installing the rail industry's most controversial and effective operational mastermind, E. Hunter Harrison, as the new CEO.
Harrison was notorious for implementing the strategy known as precision scheduled railroading, or PSR, at multiple other railroads. His involvement meant the overhaul would be immediate, comprehensive, and potentially ruthless.
The activist demands succeeded. Harrison was hired in the spring of 2017. However, his tenure was tragically short. Harrison, who was known to be in fragile health, died suddenly on December 16, 2017.
Which created this enormous leadership vacuum at the exact moment the company was undergoing major structural surgery.
Right. James M. Foote, the chief operating officer, was quickly named president and CEO shortly thereafter.
And Foote's critical decision was not to pivot away from the Harrison strategy, but to commit CSX fully to the scheduled railroad model that Harrison had initiated.
This strategy, precision scheduled railroading, is not just an operational change. It is a fundamental philosophical shift in how a railroad is run.
Okay, so let's unpack PSR because this is the key to understanding the modern company. A traditional railroad operates reactively, right? It moves trains when freight is ready.
It's sort of like a taxi cab service, waiting until a block of traffic is full before moving it. PSR, by contrast, is more like an airline model.
It demands fixed schedules regardless of whether a train is perfectly full.
Exactly. You run fewer, longer, and faster trains on fixed clockwork schedules. The goal is to reduce variability, minimize bottlenecks, and most importantly, maximize the financial metric known as the operating ratio.
And we have to define the operating ratio, or OR, clearly, because it is the central driver for activist investors. What exactly is it?
Simply put, the operating ratio is calculated by dividing your total operating expenses by your net operating revenue. If a company spends 60 cents to earn a dollar, its OR is 60%.
And the lower the ratio, the more efficiently the railroad is being run.
And the more lucrative it is for shareholders. So activist investors like Mantle Ridge look at CSX's OR, see room for improvement, and demand Harrison's PSR strategy because it is proven to slash that ratio dramatically. The goal isn't necessarily better service. The goal is a reduced ratio.
And that required radical surgery on both physical assets and human capital. The source material gives us some hard data from early 2018 showing the dramatic scale of the planned reductions.
Yeah, let's break down the asset reduction first. To run fewer, longer trains, you need fewer spare parts, fewer idle machines. So CSX set out to cut hundreds of locomotives.
They reduced the active fleet from 3,000 in late 2017 down to a target of between 2,370 and 2,420 by 2020. That is a massive divestiture of heavy machinery.
The same logic applied to rolling stock the rail cars. They plan to reduce the number of rail cars from 136,000 to between 104,000 and 109,000 by 2020.
The PSR principle seems to be, if an asset isn't generating maximum revenue, get rid of it.
That's it in a nutshell. But this is where we need to address the controversial side of this financial strategy. This level of asset efficiency comes at a human cost.
The source material details massive workforce reductions. The numbers are stark.
They really are. In 2017 alone, implementing the initial phase of PSR led to 3,300 job cuts. That was followed by 2,200 more cuts in 2018.
And the plan projected a further 4,000 positions cut by 2020, aiming for a total workforce of around 21,000 people.
A reduction of close to 10,000 positions over a few years is staggering.
It sounds like a wildly successful financial surgery from the shareholder perspective, but for the communities along those 21,000 miles, this was a massive job shock.
For sure. And there were significant complaints, particularly in 2017 and 2018, about service issues, delayed shipments, closed yards, lack of responsiveness. The sources imply that the initial shockwave of the rapid transition, coupled with the loss of institutional knowledge from the cuts, caused temporary upheaval.
So in the short term, the company prioritized achieving the target operating ratio over maintaining the previous level of customer service.
Which highlights the core tension of PSR, the financial health of the corporation versus its function as critical national infrastructure. You reduce labor and assets to boost efficiency, but you also remove the buffers, the redundancy, that allow you to respond to unexpected weather, accidents, or spikes in demand.
And that tension is absolutely key. Simultaneously, CSX looked at how to monetize the physical resources outside of the tracks themselves. The real estate strategy became crucial.
Right. It was necessary for generating the capital needed to fund the restructuring and satisfy investor demands. They aimed to generate a whopping $800 million by 2020 just by selling off some railroad lines and real estate holdings.
Across the 23 states and 2 Canadian provinces where they held property, that is a direct link between financial strategy and asset disposal.
They were effectively trimming the fat, both human and physical, to achieve that lower operating ratio.
And this relentless pursuit of efficiency means leadership often changes quickly. James M. Foote, who implemented the plan, stepped down in September 2022, replaced by Joseph R. Henrichs.
And Henrich's tenure was also brief, lasting only until September 2025. Steve Angel was then appointed president and CEO, again amid reports of ongoing activist pressure.
This rapid rotation at the top just underscores that once a company commits to the PSR model, the constant demand for maximizing the operating ratio becomes the primary metric of CEO performance.
And John J. Zillmer is the current chairman of the board, tasked with navigating these high-stakes transitions.
Okay, let's ground ourselves back in the physical reality of managing this 21,000-mile system. Running an operation this large requires meticulous organization. CSX divides its operational control into 2 vast regions, East and West.
And those primary regions are further subdivided to manage the day-to-day logistics, maintenance, and traffic flow in dense corridors. This decentralized structure ensures efficiency.
So in the East region, you have the Northeast region, which is coordinated from Baltimore, Maryland, and the South region, which operates out of Waycross, Georgia.
And Waycross, in particular, hosts a massive hump yard and serves as a major hub for their southern operations.
In the West region, they manage the Midwest region, based in Cincinnati, Ohio, and the Southwest region, which coordinates traffic and logistics from Nashville, Tennessee.
So these four centers are the nerve centers that coordinate hundreds of trains, thousands of personnel, and the movement of freight across half the continent every single day.
Now, let's tie the aggressive restructuring we just detailed back to the financial statements. The numbers are the undeniable proof of the PSR concept, at least for shareholders.
Right, let's look at the immediate growth trajectory following that 2017 activist intervention. The efficiency metric shifted instantly. Revenue saw a solid increase from $11.408 billion in 2017 to $12.25 billion in 2018.
That's solid growth in the top line, but the real story is the change in the operating income, which directly reflects the cost-cutting and asset optimization achieved under PSR.
That's where you see it. Operating income saw a huge, substantial jump, moving from $3.72 billion in 2017 to $4.869 billion in 2018.
That is over $1 billion in operating income improvement in a single year.
In 1 year, that is a massive validation of the financial goals of the scheduled rail model. This rapid improvement is exactly what activists demand and what drove the stock price higher.
Similarly, earnings before income taxes jumped from $3.142 billion to $4.304 billion in the same period. The dramatic reduction in the operating ratio, the primary goal, was achieved almost immediately.
This financial acceleration solidified CSX's position not just as a railroad, but as a premier, high-performing financial vehicle within the transportation sector.
Looking at the most current data available in the sources from 2024, the company's massive financial heft remains. Total revenue is $14.5 billion, with operating income holding strong at $5.25 billion.
And net income at $3.47 billion. Total assets have climbed to $42.8 billion. The company remains a financial powerhouse.
And finally, let's return to their centralized home base in Jacksonville, Florida, the CSX Transportation Building. Even this physical structure connects back to the company's complex ancestry.
It's a 251-foot high-rise right on the St. Johns River in downtown Jacksonville, completed in 1960. Architecturally, it's a great example of mid-century modern and international style architecture, and is also LEED certified.
But the history of the building itself directly traces the corporate lineage we talked about. It was previously known as the Atlantic Coastline Building and the Seaboard Coastline Railroad Building.
So even the physical headquarters serves as an architectural remnant of the Seaboard Coastline Industries, the exact company that, through the merger with Chessie, necessitated that desperate, temporary, and ultimately permanent name, CSX.
This deep dive has traveled from a moment of accidental branding and corporate necessity to a revolutionary era of financial strategy and asset overhaul.
In synthesis, CSX is a product of unavoidable corporate necessity, the merger of equals, that resulted in a placeholder name which became its destiny, and its current structural complexity, particularly the unique joint management of the residual Conrail assets.
That ensures crucial competition in high-density areas.
Right. And its modern identity is defined by the absolute radical adaptation forced by activist investors.
The push toward the precision scheduled railroading model led to the disposal of hundreds of locomotives, tens of thousands of railcars, and the reduction of nearly 10,000 jobs, all resulting in a dramatic, quantifiable improvement in operating income in just a few short years.
This transformation proves that even a massive 21,000-mile network, seemingly built on concrete and steel, can be fundamentally reshaped and monetized based on financial pressure.
We've seen how CSX successfully pursued efficiency by cutting its physical footprint and workforce to improve profit margins. They generated $800 million by monetizing real estate by 2020, focusing on hyper-efficiency today. But this raises a profound question about the future.
How does this ongoing, relentless drive for immediate financial efficiency, like a constant push to lower that operating ratio balance, the need to retain essential infrastructure and operational buffers for future national transportation demands? CSX is a component of the Dow Jones Transportation Average, meaning its health reflects the entire logistics backbone of the nation.
So when you trim assets so aggressively, at what point does immediate financial gain compromise the resilience and capacity necessary for long-term growth and national security?
That balance between profit-driven efficiency and resilient national infrastructure needs is the complex question CSX, and frankly, the entire North American rail industry will continue to grapple with.
Thank you for joining us for the deep dive.